How to use the Bear Sp500 ETF. The economy runs in cycles, full recessions every few years. The last real downturn was in the early 1990s. The one in 2002 was incomplete. Recessions and stock market plunges have a cleansing effect, setting the stage for renewal in the next expansion phase. The Fed cannot keep the system propped up forever. It is running out of silver bullets. Lower interest rates are not stimulating the economy. There is a pyramid built on huge debt leverage. The scary aspect of all this is that there is just so much we don't know. There are more things that can go wrong, and every month there seem to emerge unforeseen financial problems. Most of this stems from too much debt and leverage. Brokerage firms in the 1970s were not allowed to have debt of more than 12 times equity capital. These days a ratio of more than 30 is the norm. Mortgage, consumer hedge fund, and almost every other type of debt have multiplied several-fold over the last decade or two. Even during normal periods, the stock market incurs regular slumps. From 1926-2007, the S&P 500 index dropped 3 out of every 10 years. During bear markets there are numerous false rallies of more than 5%, a dozen or so. For example, during the 2000-2002 bear market. Despite this sobering scenario, you won't hear your brokerage firm or major TV stock market shows dwelling on any of these issues. They are cheerleaders and promoters. Wall Street is always in denial, eternally optimistic with a systemic positive bias. An automobile dealer sells cars. Brokerage firms sell securities. Both generate revenue from transactions. The favorable bias is an inherent aspect of the businesses. Stock investment ratings are similarly favorably skewed. Even in today's bad market, there are less than 10% sell ratings, more than 90% buys or neutrals. Sometimes outperform indicates a stock is expected to fall, just not quite as much as the other names in the sector. An opinion shift from buy to neutral is a strong negative signal to unload the stock in street code. Brokers rarely have the courage to use the gloomy S word. Earnings estimates are no different, almost always too optimistic. In most cases, street analysts take as their profit forecast a projection published by promotionally ebullient corporate executives. Stock price targets as published in research reports are yet another overly positive bias. How many times do you see downside worst-case stock price possibilities highlighted in a report? Never. The street is all about how much money you can make the upside, not how much you might lose. Wall Street is never focused on risk. It is always about stock price appreciation prospects, not about protecting capital conservativeness, how much you might keep. Even amidst a precipitous stock price decline such as in financials and home builders over the last 12 months, the street focuses on catching a falling safe, that is, guessing the bottom for a purchase recommendation rather than avoidance. Brokerage emphasis lists are all buys, never sell ideas. No matter how negative the current market conditions or how uncertain the outlook, you cannot rely on Wall Street for objective advice on risk. In view of the tens of billions of dollars in losses incurred by the street with bad subprime loans and other debt instruments, it is hardly in a credible position to address risk. Wall Street didn't manage its own risk, don't expect it to focus on yours. Stephen T. McClellan, CFA, is a former Wall Street investment analyst with 32 years of experience covering high-tech stocks. He spent 18 years as first VP at Merrill Lynch and 8 years as VP at Salomon Brothers. McClellan had ranked on the Institutional Investor All-American Research Team for 19 straight years and on the Wall Street Journal poll for 7 years. He is in the journal's Analysts Hall of Fame.